RBI's decision to maintain the repo rate. The Reserve Bank of India, RBI, is the central banking institution of India, responsible for the country's monetary policy and the regulation of the banking sector. One of the key tools at the disposal of the RBI is the repo rate. In this video, we will explore what the repo rate is and why the RBI might decide to keep it unchanged in the Indian economy. Let's start by understanding what the repo rate is. The term repo stands for repurchase agreement, which is essentially a short-term loan provided by the RBI to commercial banks. The repo rate is the interest rate at which banks can borrow money from the RBI. It acts as a benchmark for other interest rates in the economy. The repo rate is a crucial instrument in the RBI's monetary policy toolkit. When the RBI changes the repo rate, it can have a ripple effect on the entire economy. If the RBI raises the repo rate, it becomes more expensive for banks to borrow money. This, in turn, can lead to higher interest rates on loans for businesses and individuals. Conversely, if the RBI lowers the repo rate, it becomes cheaper for banks to borrow, resulting in lower interest rates for loans. One of the primary factors influencing the RBI's decision regarding the repo rate is inflation. High inflation can erode the purchasing power of the currency, making it more expensive for people to buy goods and services. To control inflation, the RBI may decide to increase the repo rate. This encourages banks to lend less and consumers to save more. On the flip side, the RBI also considers economic growth. If the economy is sluggish, the RBI may lower the repo rate to encourage borrowing and investment. The RBI doesn't make decisions in isolation. It takes into account several external factors. Exchange rates, global economic conditions, and geopolitical events all play a role in the RBI's decision-making process. Now, let's talk about the RBI's decision to maintain the repo rate. It may do so for several reasons. One key reason could be that inflation is under control. If the RBI believes that inflation is within its target range, it may choose to keep the repo rate unchanged to support economic stability. On the other hand, if there's economic uncertainty, the RBI may opt for a wait-and-see approach. Keeping the repo rate steady can provide a sense of stability in uncertain times. When the RBI decides to maintain the repo rate, it can be seen as good news for borrowers. They can expect their loan interest rates to remain stable. However, for savers, an unchanged repo rate might mean that the interest rates on savings accounts and fixed deposits won't increase significantly. The RBI doesn't make decisions about the repo rate single-handedly. The Monetary Policy Committee, MPC, is a group of experts who meet to discuss and decide on the repo rate. Their decision is based on a consensus, and it's influenced by various economic indicators. In conclusion, the RBI's decision to maintain the repo rate is a carefully considered move. It balances the needs of borrowers and savers, the state of inflation, and the overall economic health of the country.